Right, I think we can get started then soon. I think we have one more panelist to join, but we can get started in the meantime. So, well, folks, welcome to Scaling DeFi, a dive into the future of decentralized finance. My name is Boaz Shoshan. I'll be moderating this fascinating discussion on the future of DeFi. Now, just to start us off, a little bit of housekeeping to do before we introduce the panelists. The purpose of this webinar is informational only. It's not to be interpreted as financial advice. So please do your own research before taking a look at any of the markets or placing any capital into it. Just to introduce our great array of panelists here. We have Steve and Juan from Circle. We also have Ben from Solana. And indeed, we shall soon have Yutaro Mori, the co-founder of Orca. Just to get us started, I thought we could start with our very gracious hosts over at Circle. Steve Leahy, could you give us a little bit of background about yourself and what you do at Circle?
Sure, thanks, Boaz. I'm happy to be here. So I'm Steve Leahy, and I head up Circle's Institutional Trading Partners Program. So myself and the small team here at Circle, we interact with all the institutional asset managers, the exchange operators, the market makers, and a lot of the DeFi protocols out there in the space. For me personally, a long time ago, I was in traditional asset management, doing some structured FX products, built a few startups in the order routing system world, caught the crypto bug in 2016, and been in the space ever since. So happy to be here tonight. It's going to be a good conversation.
Well, thanks so much for joining us, Steve. On to Juan. Could you tell us a little bit about yourself, Juan Lopez, and what you do at Circle?
Yeah, absolutely. So, hey, everybody, I'm Juan Lopez, and I'm part of the Circle Ventures team. Circle Ventures is Circle's own ecosystem fund, where we deploy resources and capital across a number of startups, partners, and even Circle clients that drive synergies with USDC, Verity, or Circle's products. I come from a background in consulting and also product marketing, and I'm based out of Miami, and I love making music. So I'm super excited to be here with Orca and Solana to talk about DeFi.
Great stuff, great stuff. And Ben Spargo, Benny Bitcoins, as he's known on Twitter and elsewhere. Ben, thank you so much for joining us. Tell us a little bit about what you do at Solana.
Yeah, thanks for having me. I am the head of business development at Solana Labs. I focus broadly on the 5 main sectors that we think are most valuable to the Solana ecosystem right now, that being DeFi, NFTs, DAOs, payments, and gaming, and kind of oversee each of those initiatives and how we're driving to specific objectives in each of those to grow the users on top of Solana.
So many things that we could and hopefully will discuss and have time to discuss this evening. Thanks to everybody who have joined in for this webinar this evening. I over here in the UK, it's just after midnight, so I wish everybody in the UK a very good early morning. But we do have a great array of time zones here, and indeed, I believe we should have Yutaro Mori here. Yutaro, can you hear us?
Yeah, can you hear us? Or can you hear me?
Yeah, we can indeed. Yutaro, I was just doing the introduction, so you're right on time. Yutaro Mori, you're the co-founder of Orca. Can you tell us a little bit about yourself and what you've created with Orca?
Sure. So I'm Yutaro, one of the co-founders of Orca, along with Ori, who is supposed to join, although she caught COVID, so she's not able to join. I'm stepping in. I am one of the technical lead, I suppose, for Orca. Before that, I was involved in Ethereum 2.0 and other DeFi protocols on Ethereum. And Orca, I suppose the way I would explain it is the simplest DEX to use on the Solana ecosystem. Recently, we've launched a concentrated liquidity AMM, which allows liquidity providers to provide liquidity for users to swap with less capital. So increased capital efficiency. Yeah.
Oh, great stuff, great stuff. And yours truly, I'm also with Orca, the decentralized exchange. And as Yutaro says, we've recently introduced concentrated liquidity, which is hopefully something we'll be able to discuss this evening as well. As I say, great array of panelists. Thank you all so much for joining us here for this live webinar. And hello to everybody in the chat. We shall have time for a few questions at the end if you want to post them in the chat. And at the same time, if, as I said, the time zones here, we have quite a diverse array of time zones here. So if you do have to dash off either to go to bed or to go to work, wherever you are in the world, have no fear, because we will be recording this webinar and indeed the Twitter spaces that we'll be hosting right afterwards. So that is, I think we can get straight into the discussion from here. Just a quick note to all of our panelists, as I am moderating this discussion, but you don't need to wait for me in between responses. If someone says something and you'd really like to add to it, or you'd like to debate it a little bit, have no fear, just go straight into it. You don't need to wait for me. Just to kick us off, I thought we'd start with sort of the base layer of the Solana ecosystem. So starting with Ben, tell us a little bit on where you think DeFi is going and some of the interesting trends you see emerging in the space.
Sure. So for the last year and a half, at least in Solana in particular, the focus has been on building the core primitives that you need to build, just the base foundational primitives that you need for a thriving DeFi ecosystem. So Orca being one of those, an automated market maker, simple transactional protocol where you trade one asset for another. But in addition to that, lending protocols, and then beyond that, just derivatives protocols and everything else that people use within the ecosystem. So the primary focus has been like really making sure that those products are good, they have the proper liquidity, and they've set a good base for the rest of the DeFi ecosystem. And now I think the focus is shifting over to, okay, now that we have these core foundational primitives, what are the interesting things that Solana uniquely allows for that we can build on top of those? So we're starting to see like the budding of those iterations with other DeFi protocols. One of them that is launching imminently that I'm super excited about is called Parcel, where it's very similar to MakerDAO, where you set up like a collateralized debt position in order to mint parcels. But when you're minting parcels, you're effectively minting a asset that is tracking the price of a certain neighborhood somewhere in the world. So the real estate prices of those neighborhoods. So it effectively makes a way that you can either go long or short certain asset prices around the world, which is super interesting. And it's not possible without those foundational primitives like Orca and Jet Protocol and everything else that Solana DeFi ecosystem has now. But we're just getting to that point where people can now build on top of it. At the same time, I think it's very clear that globally regulation is going to be coming down pretty heavily on crypto. It's luckily we have a bunch of awesome groups that are working very closely with the regulators to make sure that it's done in an intelligent manner rather than a restrictive manner. But one thing that's very important to us is making sure that we have the proper compliance tools so that DeFi can be accessible by institutional clients who need that compliance check in order to trade. They need to make sure that they're not, the counterparty in their trade is not a sanctioned individual, and that, you know, source of those funds is not coming from anywhere illicit. So one thing that I'm seeing now is people taking an interest in integrating identity solutions, whether it's something manual, kind of similar to like an Aave Arc solution on Ethereum, or some of these decentralized identity protocols that are now integrating into DeFi, adding credentials to wallets so that dApps can then interface with those wallets and know that this person has been KYC'd and that they're not a sanctioned individual.
Very interesting stuff. And there's sort of a side of that. You're talking about the building the strongest foundations within Solana ecosystem, sort of the channels by which value can be transacted and played around with. There's sort of an edge on that I'd like to explore a little more with the Circle guys. Steve, when you're thinking of a strong foundation to build upon, USDC, you know, the stability, the stable value of USDC is of course core to the Circle product. Very, very interesting. And of course, Circle has flourished and USDC is, you see it all over the place these days. But based on this strong foundation, where do you see it heading next? What's the big focus for Circle from here?
Yeah, so thanks for that, Boaz. And I'll add that, you know, the growth of USDC, and specifically as USDC was put onto the Solana blockchain, really helped us flourish and was really one of the fastest growing native blockchains upon which USDC resides. I think Ben touched on a couple of really important factors there about institutions, about what institutions need to be comfortable getting into the space. And you know, one of the things that when I talk to some of the traditional asset managers who are kind of dipping their toes and getting into the space a little bit more, they obviously see the volatility and the risk of many of the traditional crypto or digital assets that are out there. And for some of these traditional institutional asset managers, if they're not specifically like a risk-taking firm or a high-frequency type trading firm, again, they see some of the risk characteristics of many of the assets, but now they're starting to look at DeFi, and they started to recognize that, for USDC as a regulated, stable, fast-growing stablecoin, the risk doesn't necessarily have to be in the actual asset that one is holding. The risk can be in how that asset is used. And so that's really where we see a heck of a lot of growth coming in the next 12 to 18 months here over at Circle, a continued expansion of DeFi, more and more use cases for digital dollars. A couple of interesting use cases in trade finance have kind of popped across our desk recently. And so again, we view it as almost for traditional asset managers who are stepping into the space, they're a bit wary of some of the volatility of the kind of crypto assets per se, yet they recognize that by having a stable underlying asset, USDC, you can still go out and find what I broadly consider credit risk or protocol risk, and that's what they're using USDC for. We think there's going to be massive growth there from the large name institutions over the next 12 to 18 months.
Very interesting indeed. Juan, would you like to expand on that a little bit?
Absolutely. No, happy to do so. And at least from the Circle Ventures perspective, I would say that there's a couple of points that we're touching on that are really looking to expand on the growth that we expect for USDC and just the Web3 ecosystem at large. I would say that there's primarily, three things that we're looking to drive and that we're super excited about. It's, I would say the distribution of USDC, really being able to get USDC to the applications with the best user experience, but facilitating liquidity to move freely across blockchains. So when we talk about bridging technology and the Circle account, we're really looking to drive liquidity that can move to the ideal user experiences that are presenting like novel designs to trade or to essentially execute anything that a particular user is looking for. The second thing would be more utility. So just like we covered examples in trade finance or extension of credit, crypto gaming, things of that nature, that we're starting to back and support companies that are really presenting novel ways to build applications on chain, and we're seeing a lot of that sport out of the Solana ecosystem. But last but not least, I think we touched on this, and that is there's a number of institutions that are looking to participate that are subject to AML and KYC regulation. That it's through integrations with what we're building with Verity, as well as collaborating with other folks in the ecosystem that are enabling permissioned versions of DeFi that are enabling these institutions to really participate, and they're doing so with USDC. So I would say those are some of the kind of interesting factors that we're really looking forward to, that we think are going to drive growth in the Solana ecosystem, as well as in applications like Orca, and then with USDC more broadly.
Oh, very cool indeed. A lot of what we've heard so far is dealing with TradFi institutions, and of course with the government through the regulator. But of course, just internally inside the space, you see a lot of evolution going on as well. And Yutaro, I think this is something that maybe you could expand on a little bit with what you're seeing taking place inside, really deep in the DeFi world, when it's all about development and there's a lot less of the sort of the TradFi influences going on. Could you tell us a little bit about what you're seeing sort of at the bleeding edge of the Solana ecosystem?
Sure. So I would say what I'm observing is that Solana, at least from a technical foundational perspective, is going through a bit of a, let's say, like growing pains, which essentially every single layer one blockchain that's reached mass adoption, let's say Bitcoin or Ethereum, has experienced. Bitcoin has definitely experienced that every single time there was a bull run. Even in the last two cycles, Ethereum experienced that. If you recall something like CryptoKitties and how that slowed down the blockchain in 2017, we're kind of seeing a bit of that, and we're also seeing the solutions that are coming out. So I think even recently Anatoly tweeted about some of the shorter term solutions for all of the block congestion that's happening right now, and then also the longer term solutions with transaction fees. So I think we're going to see kind of applications adapt to the changing environment of the blockchain, whether it be transactions being dropped or these transaction fees coming in. And that's something that we've always been cognizant of. The idea that, the Solana blockchain, despite the fact that it can potentially support, 10,000 plus transactions, will eventually be full because, there's definitely enough of a vibrant ecosystem for those transactions to be filled up.
Where do you think that? What do you think that might push a lot of the Solana applications into doing when the Solana sort of block size does get full like that?
Yeah, so I think we're going to see kind of more of an emphasis on the efficiency of the application compared to before, where in the past, I think there was this assumption that, transactions would essentially be free and that, you could do things that were impossible to do in the Ethereum ecosystem. For example, cranks, right? Cranks are a mechanism, if you're unfamiliar, essentially kind of a third-party processor that's continuously submitting transactions to push the state forward for a particular smart contract. So you see that in a few smart contracts in the Solana ecosystem. You really don't see any of that in the Ethereum ecosystem. But I predict that those kinds of expensive designs will go more out of favor. I think that we'll also see a proliferation of MEV, and MEV will be kind of essentially something that smart contract developers and application developers will have to be more cognizant of.
Yeah. Well, on that, Ben, from your vantage point with the evolution of smart contracts and the direction in which they head and what gets prioritized when developing smart contracts, is efficiency one of the things that you see as a main priority? Are there other elements there too?
Yeah, but before I address that, I just want to touch on something that Yutaro mentioned. I think there's a common misconception, especially because Solana is just a very new architecture to a lot of people in the way that other blockchains work. That the misconception is that Solana blocks are full, and Solana blocks are not actually full, and that's not the result of the congestion. Anatoly had a really good explainer on this the other day, where it's that we haven't figured out how to deal with the spam transactions properly. So like when an NFT mint or something that everybody's trying to get after, people are spamming the network with millions of transactions per second. And instead of the blocks being full, it's more that the resources of the validators are being constrained. So like the validators need to go through and check all of those million transactions and figure out which are valid. And in order to do that, it requires a lot of resources. And so to pick out the ones that are valid, obviously your transactions are going to be coupled in there that are just normal transfers or interacting with other applications. It just takes a while for them to go through that, and your transaction will eventually time out. And that's what's causing some of the issues. So Anatoly addresses that. I just want to make that clear that we're not reaching any block limits at this point. It's just we need to make optimizations on how the blockchain deals with these types of transactions in order to properly move forward without affecting everybody else. But to answer your question, yeah, I completely agree. There needs to be optimizations in the code, because the messier the code, the more intensive it is on the block producers to execute those contracts, and the cleaner that can be reduces the general load on the entire ecosystem. And if everyone, it's just going to take time, because the Solana ecosystem is still very new in comparison to some of these other blockchains. People are still learning the best ways to write contracts on Solana, and once it becomes common practice and everyone's used to, oh, you write it like this and not like that, it's going to reduce that strain on the network, and it's going to increase the performance of both the applications and the general network.
When you're talking about it's not stripping out the spam transactions or what you'd consider to be spam transactions, but more efficiently sorting them almost. Is there a word for what that practice might be and how we might see the infrastructure adopt that kind of approach?
Yeah, I don't want to speak to it too deeply because I don't know it as well on a technical level as some of the engineers and Anatoly do on my team. But one of the things that Anatoly consistently talks about that's coming in the next validator client release in 1.10 is a concept called Quick. And as it's QUIC, and as I understand it, it's a way for the network to more generally figure out which IP addresses or wallets are spamming rather than just sending valid transactions, and basically like remove those spam transactions from the queue until that person stops spamming. So it wouldn't allow you, it would basically effectively be like a rate limiter on your wallet until you stop that malicious behavior.
Can I just add in there that I think those changes coming are going to really, and along with some of the topics we want to discuss a little bit later with Yutaro, as far as Whirlpool goes, I think that's going to bring in a lot of the traditional high frequency firms that have yet to step into the space. I think those changes you were mentioning there, Ben, and again, some of the tools in the AMMs that are coming out, especially on Orca, are going to bring a lot more liquidity into these decentralized protocols. That's for sure.
On the Circle side with USDC, of course, this is scaling DeFi. We are speaking a lot about Solana, of course, but USDC is not Solana specific. Just on your observations in DeFi more generally, are there any observations that you think is unique to Solana? Are there any trends you're seeing in Solana that you don't see on some of the other chains that USDC is mounted on?
I'll tell you what, I can talk that at a kind of capital markets level. Maybe Juan can dive a little bit deeper after. But the thing that I'll note is that Solana really grew in adoption by the market making firms as soon as a number of these large exchanges have started to allow for USDC on and off ramps. USDC on Solana is continually grabbing more and more share of like the rebalancing and the on and off ramps that these market maker firms are doing. They're taking that from Tether on the Tron network. And so I think that because of that quick adoption by the market makers in their centralized trading use cases, I think they've got USDC on Solana in-house, and therefore it's easier to move into the DeFi space. But I'll kind of pause there and let Juan pick up on what I was talking about and answer your question better.
Yeah, no, I mean, I think at least from my side, I think that the technical scalability and the ecosystem investment that's gone behind Solana has just really driven network effects, mainly due to the really talented groups of people that are coming together to build on top of that. So it's primarily what we've seen is that we've run into a number of applications, founders, startups, projects, partners that are looking at that ecosystem, mainly because that's where a lot of the really interesting partners, their partners are building in. So that really adds to the whole composability aspect of building in Web3. So there's just been a number of applications that have been building there that just are highly composable with what we're doing at Circle and the products that we're building on top of USDC.
Yutaro, he's talking about you. Do you want to expand a little bit on some of the optimization, some of the efficiency that you've worked so hard on over at Orca with the concentrated liquidity side of the AMM? Because while I do work at Orca, of course, I'm not an engineer, and this is something you know inside and out like the back of your hand.
Sure. So if I may get nerdy for a second. So there are a few things. I can name one, for example, so generally what happens frequently in a smart contract that doesn't happen elsewhere is that we have to handle large numbers, mostly because the raw units that the tokens are handled in are usually like 10 to the 6 is like the base unit. And then it can go up to essentially like 2 to the 64 units max. And so what we've developed is a 256-bit library. It's a lot more efficient than the standard one that everyone uses. There's a 256-bit library that's used in all the Solana programs, actually. And what we found is that it was incredibly inefficient. We re-implemented it, and it's more kind of efficient in a few orders of magnitude. So I think that one's pretty interesting. Another thing that we did that we're quite proud of is we've reduced the cost of initializing a pool down to kind of essentially, let's say, like half a sol for initializing a new pair. That's something that was pretty important because we're going to support permissionless listings. And so we want to allow the long tail of tokens to be able to create a new create a new pool without having to pay a large upfront cost. Beyond that, I think this is not necessarily at the smart contract level, but Ori's done a great job with the design. Since concentrated liquidity AMMs are a lot more complicated than normal AMMs from the LP perspective, she's created a design that's easy to use and is kind of a gentle onboarding for anyone that wants to provide liquidity.
Yeah, I mean, if we're talking about scaling DeFi, ultimately, still you need to make it really, really easy to access, really, really easy to use. And of course, that's a big priority over at Orca. It's very interesting, the blend of efficiency and optimization, which of course has a lot of complexity to it. But at the same time, making something simple and easy to use, it's pretty hard to square that circle or to balance that. On the topic of making things more efficient, more generally, obviously on the AMM side, that's been a big focus at Orca. For Ben, in terms of efficiency and optimization, are there any other edges of that, any other trends that you've seen in other apps that are outside of exchanges or market making?
Yeah, I mean, I think to just add to my previous point, I think just generally, as the ecosystem gets more sophisticated, there are just general optimizations that people can make. And as people get more used to the architecture of Solana and how you interact with other applications and how it generally gets processed by the validators, people are going to learn over time the do's and don'ts of how to write smart contracts and how to route transactions properly to make the best possible user experience. I think ultimately it's just going to take time. And right now, like people like Yutaro and the Orca team, who have been in the Solana ecosystem pretty much since the get-go, are the best people to be the advocates for how to do this properly and relay that to the rest of the ecosystem as more people come in through the hackathons and the hacker houses, and we add new people to the Solana ecosystem and to crypto in general.
Yeah, the market structure is something I'd like to focus on and see what everyone's thoughts are on what DeFi market structure looks like in the future. It's something almost niche and esoteric with TradFi is the market structure itself. Generally, it's professionals who are really aware of how orders are cleared and executed and things like that. And DeFi is very, very open, but I think there's still there's not a huge amount of awareness from the everyman on exactly how things work. But of course, it's a very evolving space. There's still so much development going on, and it's something I'd like to explore a little bit here. So, for example, with order books and automated market makers, what are the differences with these, and what are the advantages and disadvantages with that? Actually, maybe I could start off with Yutaro there, because of course you've with concentrated liquidity with whirlpools on Orca, you're looking at concentrated liquidity AMM, and that was a conscious decision to go for the AMM route rather than the order book route. What was the reasoning behind that? What were the advantages, you think?
Sure. So I would, obviously I come from a fairly biased perspective since we are developing concentrated liquidity AMM. I will try and provide a relatively balanced view. So first of all, I would say that my prediction is that over time, AMMs are going to become more and more sophisticated and is going to ultimately look very similar to a concentrated or a CLOB, central limit order book, in the sense that it will provide very similar control for liquidity providers. I mean, liquidity providers are just a synonym for market makers. Market makers are just a word that is traditionally used for order books. But I predict that liquidity providers on AMMs will have similar control in how they will provide liquidity to market makers in the order book world. We're already seeing that with concentrated liquidity AMMs, and I predict that that will kind of continue to progress. But one of the key differences, even when that convergence happens, is that with a AMM, every time a user makes a trade, the price automatically shifts. Whereas in an order book, anytime a trade happens, the market makers have to adjust their orders with the moving price. And I think that the consequence of that fairly subtle kind of distinction is that AMMs will, in general, be more kind of compute efficient on the blockchain and will also take up less space on the blockchain, because every single time a trade happens, the orders, or essentially the liquidity in a pool for a concentrated liquidity AMM, is going to be automatically adjusted. And I think we're already kind of starting to see that if we look at the data on the Solana blockchain. If we look at kind of which transactions are taking up a lot of space on the blockchain and which ones require a lot of maintenance. And so I'm interested to see kind of how that evolves and how that narrative shapes up. But I think that would be kind of the key difference if I had to pick one.
On that note, with which one you think will prevail in that matter, which one will become more popular, where capital will which capital will favor over time? Steve and Juan, as you're so closely linked to the base, the foundation of so much of DeFi, I think it's a very good question for you to ask where you think the market structure is heading, because ultimately so much of that market structure is going to rotate around USDC.
And market structure nerd talk, here we go. Now I'm into this. I love it. Yeah, you know, I gotta say, I think for my thesis a couple of years ago was that a lot of the central limit order books were going to see a lot more VC backing and growth initially a couple of years ago, because quite frankly, a central limit order book, an exchange, custodying assets, you got a lot more ways to make revenue. So the VC money like flowed into those for a number of years. Done. DeFi, I think, is still, there's a lot of market participants, investors in the space still trying to wrap their heads around it. And some of the changes, there's, you know, as Yutaro mentioned, like a small nuanced change is, as he mentioned, right, in an automated market maker situation, the price changes automatically, whereas in a centralized limit order book, everyone's got to make some adjustments, a lot more orders flowing back and forth, a lot more computational power. As that level of market nuance or market structure nuance gets understood by some of the larger players, I think that that move to DeFi and these automated market makers is going to happen. Though again, I would caution that because the centralized limit order books, A, have more ways to make revenue, B, are easy to regulate, kind of the traditional venture money has flowed into them. It's going to be slower to pop into DeFi. However, you don't need as much money to pop up a decentralized exchange and protocol, an automated market maker, right? There's a lot less overhead there. And so I think the change will happen. I think it's going to be a little bit, again, challenging for the traditional names to get their head around the space, but it's going to happen. I think more and more changes, the more, quite frankly, the more the protocol, the DeFi protocols can make the speed, you know, Yutaro and Ben have both touched on increasing speed coming up on the Solana blockchain and how these AMMs are processing. That's really what it comes down to. That's going to draw in more and more traditional finance, market makers, LPs, high frequency funds. That's what draws them in. Get them comfortable with it. They know there's a lot of retail flow out there. Retail flow generally has really good what's called yield decay out there, and so it's attractive to these traditional market makers out there. They just need to get a little more comfortable with the space.
I will leave the market structure insights to Steve, but I would say what I am excited about is how designs like concentrated liquidity introduce opportunities for new participants to continue to drive the product innovation lifecycle. And ultimately that funnels cost savings and efficiencies down to all the users in Solana, and it introduces a competitive edge to dApps like Orca, which other applications will try to model their designs after. So that's a question I would love to ask the Orca team, is like, how do you see new participants that look at designs like Whirlpool and seek to become specialists in deploying liquidity in a concentrated fashion?
I'll leave that one to you, Yutaro.
That's a great question. So what I'm seeing is that, first of all, the first thing that I see is that there's still kind of a misunderstanding, or kind of, you know, people look at the profitability of an AMM in different ways. So one of the things I noticed is that there's a lot of focus on whether or not for example, Uniswap V3 is profitable. There's a ton of kind of discourse around that, but I find that to be fairly interesting because, well, first of all, like, there's very little analysis like that for clubs, essentially, right? Whether it be on DEXs or on centralized exchanges. And I imagine if we take the similar kind of analysis, we would see a similar kind of result in the sense that, most market makers are not necessarily profitable. And there's probably going to be some kind of power law where like a small percentage make up a lot of the profitability. And I think that is intentional, and that's by design. Like the whole idea is that liquidity providers are competing to make a profit, and then that allows essentially traders to be able to trade for a low fee and low price impact. I think another thing that I saw is that there's a lot of analysis that just looks at the positions that are created in AMMs. But it never really factors in kind of mitigating divergence loss or impermanent loss by arbitraging. And what I'm guessing is that a lot of the bigger players, the more active liquidity providers, are also mitigating their divergence loss by also arbitraging. But it's incredibly hard to do this analysis to see kind of what's going on there. And so there's a fairly incomplete picture. And to more directly answer your question, it does seem like the bigger players are kind of the folks that are the bigger players in the client limit order book world, whether it be usually in centralized exchanges. So we see, Jump, Alameda, those folks. It seems like they are the bigger players. But what I'm hoping to see is kind of new participants pop up that have never really like market made in central order books, but become incredibly sophisticated players for AMMs. I haven't seen evidence of this, but that's something that if it happens, would be kind of a very strong positive signal for AMMs.
Ben, there's an edge of that I'd like to explore a bit with you there. As I was saying with USDC, you've got that, very key to the DeFi space. But of course, Solana and Sol, of course, are integral to the entire Solana ecosystem. Are there any elements of market structure that you see changing or evolving that we haven't highlighted so far? Sorry, it's complicated. Quite, it's not an easy question, is it? But just in terms of any quick observations.
Yeah, I mean, generally, yeah, it's very, very broad. But yeah, there's tons of things constantly changing. I mean, one thing that I can touch on is structuring on like what assets people are preferring to use and like the pairings that are coming with these liquidity pools. One thing that I have in mind is like we're starting to now see the emergence of like decentralized stablecoins, in addition to like the USDC and USDT have traditionally led since like the beginning of the Solana's rise in the last year and a half. But now we're actually seeing like the first instances of like the liquidity like protocols or like the MakerDAO like protocols on Solana, which is kind of changing because the users are now able to make preferences on like what assets they want to use and what pairings that are available to them. So the ones that I have in mind specifically are assets like Hubble USDH, which you can collateralize, just like MakerDAO, you can collateralize with Sol or another asset and mint a stablecoin against. You have UXD, which is a stablecoin that's backed by a basis trade on a perpetual swap. So a perfectly hedged short and long position that is backing the stablecoin. So it's perpetually stable. And then you also have assets coming over from other ecosystems like Terra, UST getting sent through Wormhole and utilized in Solana DeFi. So in that respect, like you're starting to see evolutions of what people are interested to use based on markets that are available and different trading strategies that people are making.
Yeah. With Yutaro, you were mentioning with new participants entering and sort of cleaning house in a lot of ways using market makers. When we're thinking of scaling DeFi in general, are we thinking of the existing players getting better, or are we thinking of a lot of new participants or a lot of new capital, or really is it a combination of all of these things? It's a very broad question, but generally looking forward for the next year to 18 months, are we generally thinking that we're going to see an evolution of the existing system where, you know, mostly the same players, mostly the same capital, or are we thinking that it's going to be, there's going to be a new wave of users, new wave of capital, and we're going to see new protocols, new layers establish themselves? I'm just asking this as a broad question to the panelists, very broad question. So apologies if it's too broad, but just as a sort of a quick question.
Yeah, no. I think it's a good question. I certainly hope that there will be new players coming into the ecosystem, new application developers. The more diverse and vibrant the ecosystem is, the healthier it is for Solana as a whole. You know, where will those opportunities coming from? It's hard to say. Like, it definitely seems like right now in the Solana ecosystem, NFTs and gaming is getting a lot of attention. And so, you know, potentially financial instruments that support those kind of more novel use cases, that's probably where there are opportunities. Yeah.
Yeah. Any thoughts from the Circle side or from the Solana side?
I would say where we see opportunities is definitely in more utilities like payments or treasury management. And these are some of the investments that we're making to enhance utility of USDC on ecosystems like Solana. So particularly talking about folks like Cato or Zbeck, who we invested in, which are building core infrastructure to making it user-friendly and incentivizing users to actually come and build and use blockchains to spend, to save, to do payroll. So these are just some of the applications that I think that we're just really excited about, that I think are going to drive really strong network effects.
Yeah, I would agree with that. Things that are just like generally new applications. I feel like crypto just goes in these cycles where new things are built. People have renewed hype in what has been built. It kind of reaches this blow off top where people are like, that stuff isn't really like quite there yet, or it's not as interesting as I originally thought. And there's kind of a lull where people go back to the drawing board and build new cool stuff. And I think we're seeing that right now, like Parcel that I mentioned earlier, probably going to draw more people in because it's a novel new financial product that is literally not available on any other blockchain, it is only Solana. And things like Zbeck and Streamflow, where like, obviously there's a competitor on Ethereum, Superfluid, but streaming payments is like a step function improvement on how people can get paid. Paying for streaming services, paying your income on a second by second basis so that you have that money whenever you need it. I mean, the compounding benefits of receiving money on like a second by second basis versus like a lump sum on a biweekly or monthly basis are going to change people's lives, because being able to put that money to work immediately will compound way faster for people if it's invested than, you know, those lump sum payments at the end of a biweekly or monthly payment. And even just having access to that money, being able to pay somebody else and like send that stream somewhere else is going to create a whole new composability layer of payments that I feel like we're barely scratching the surface of right now.
I'll jump in there too and just reiterate something I said earlier, which is some of the trade finance applications that I've seen kind of crossing my desk recently. You know, trade finance generally had been 60 to 90-day terms. Payments always took 2 to 3 days. Lots of attorneys, lots of escrow accounts and escrow fees. And now with smart contracts and USDC, these things are happening at a greatly reduced amount of friction, happening a lot faster for a lot less money. I think that as the kind of trade finance opens their eyes to what's been happening with a couple of these small scrappy startups, I think that gets picked up pretty quickly.
does open things up for whole new levels of productivity, and which don't need to stay just in the DeFi space in general, but more broadly. I think we could go to a couple of questions from our audience at this point. If you are watching this, I hope you're having a good time so far with this webinar. And I think we'll just dive into this one to begin with. This is from Crispin. This goes back to the capacity of the Solana network. And Crispin asks, since Solana is running out of compute on some very high-end servers, is there a possibility of going over to cluster computing utilizing lower cost hardware that can scale? Ben, have you got a response for Crispin there?
Yeah, so the thing to note is that Solana is not running out of compute. Anything that is fielding millions of transactions or pings per second is likely running out of compute, whether it's like, a database or something like that. It's an important distinction to make, that like Solana's capacity is still noted as 50,000 transactions per second. So having millions of transactions per second is well above our limits. So it's all about not processing more transactions. It's about figuring out how to handle this spam in a better way that is in line with the censorship resistance of the network, because you don't want to just exclude people from the network. It's a permissionless network. They should be allowed to do that. But at the same time, you need to re-architect some things in order to make sure that that's not harming the experience for everybody else utilizing the chain.
Very nice, concise, packaged answer there from Ben. I think that answered everything that Crispin asked. A question here from Dimitri. I think this one goes straight to you, Yutaro. Will Orca's concentrated liquidity platform have any protection for just-in-time liquidity? It seems like the ease of Solana will only exacerbate the losses incurred by passive liquidity providers compared to the established on-chain market makers.
Yeah, so I get this question fairly frequently. So for our current implementation, there is no specific mitigation that we do for just-in-time liquidity. I mean, essentially at the core of it, just-in-time liquidity is the ability to put in liquidity in between a large transaction within a single block, right? And so this is something that I think, over time as MEV, the MEV ecosystem kind of matures in Solana, we will naturally kind of modify the smart contract in order to mitigate. I also do think that, like, from the data that I've seen, actually, just-in-time liquidity only captures a very, very small fraction of total fees in any given pool. And so I could totally be wrong here, but I really don't see it as being kind of that problematic, at least for now. I could see it changing in like 12 to 24 months. But at the moment, I really don't see it as something that is going to meaningfully reduce the yield for passive liquidity providers.
I think that's I think that answers all of the aspects of Dimitri's question there. Got another one from Maria, who asks, where do you see the future of bridging in DeFi? Very good question indeed. And this is a bit, it's not that recent, the whole bridging phenomenon, but we have seen more and more of it. Very, very good to see, from my perspective at least, because it's there's a lot more sort of chain agnosticism going around. There's not so much of the tribalism where our chain is better than yours and everyone should just come over to our chain. It's a lot more open, a lot more cooperation. Ben, what do you make of the where do you think the bridging, the wormholing, the whatever word you use for it is going to go in the future as we see DeFi scale?
Yeah. So I actually was like tweeting about this with somebody on Twitter last week, but I think that bridges in their current state were just created as a response to a need. The multi-chain ecosystem just ramped up so rapidly over the course of like 12 months that people wanted to have interchain liquidity as soon as possible. And people saw it as an opportunity to build these like one-off bridges where there were simple connections from one blockchain to another, Solana to Ethereum, Solana to Terra, and people started transferring assets to and from, just assuming that that, you know, it was absolutely safe, when ultimately in response to a need, it's likely not something that is thought through on a super deep level technically. And it's also untested. Like, it's the first time that these bridges are being used and people are finding holes in them. People are constantly looking for bugs that they can exploit in these large honeypots, and bridges are some of the largest honeypots that we've had since centralized exchanges. So you think about when centralized exchanges came into crypto back in like 2012, 2013, you had things like Mt. Gox and like still to this day hacks, but over time it just got better and better and better because people ultimately figured out what these bugs are and they figured out how to mitigate them and have security around them. So I think we're just in the early iterations of what bridges look like. And I think people are going to focus a ton of resources on that right now because it is going to be important for this multi-chain ecosystem that people have trust in these bridges and they know that they're putting assets in and it's going to be guaranteed that it's not going to be exploited and they're not going to lose it at some point. So ultimately TLDR is it's very early for bridges, and I think there's just a lot of work to be done in order to harden them as a key piece of infrastructure for the multi-chain ecosystem.
Yeah, go for it.
Oh, I was going to chime in on that. So totally agree. I would say that the demand for liquidity across different blockchains and the need for bridges, just like Ben was saying, it's been driven mostly by incentives and profit seeking. And it just hasn't been battle tested enough. And it's at the end of the day, it's a pretty big opportunity, a pretty big problem space, and there's a lot of talent working on it currently. So folks like Layer Zero, Wormhole, Nomad, these are all teams that are actively working to kind of solve this engineering problem. And just super excited to see what it turns out to. At the end of the day, I think it's innovations at the application layer that are gonna drive the need for liquidity to move across blockchains. And I think we have yet to see like the dApps and the innovation in different dApps to call for enough of a strong demand besides incentives and just short-term incentives. That's really what we're gonna see, like a much larger use case for bridging.
You know, at a high level and non-technical level, to kind of lightly quote Jeremy Allaire, you know, the ability to transact value over blockchains, the blockchain you're on should not really matter. It's almost like what email client you're using. I can send a Gmail-based email over to Ben on Outlook and over to someone else on ProtonMail, you know, and so there's got to be a level or layer of that interoperability that is truly seamless, like a utility that eventually we won't even think about. At the moment, there's still a lot of competition to make that happen successfully, but eventually that becomes just background and it's just not something any of us think about going forward.
Another question from Maria, which I think ties in quite well to this, asks, curious to know why apps on Solana build with USDC. And so we were already discussing different different chains which USDC is managed on, of course, and interchain operability. But why do apps build with USDC? Well, Maria, because USDC is great. But if we go to the Circle guys, of course, they'll be slightly biased. So perhaps Yutaro, it'd be good to ask you why Orca we've included USD so often with the Whirlpool's beta, which we came out with just over a week ago. There are 3 concentrated liquidity pools there, and each one is a USDC pair. Yutaro, why did we do this?
Sure. So, we have, one, I suppose. So the most pragmatic answer is that USDC has the most demand in terms of stablecoins, right? Within the Solana ecosystem, we see way more demand for USDC trading than USDT trading. We see that even with our other pools where we have identical pairs, where the base pair is either USDC or USDT, and we just see way more trading volume. So in like a very practical A/B test way, we see that. I would also say that Circle, the reputation is quite stellar. We have there's a lot of kind of essentially FUD with every other stablecoin. It's hard to say whether or not the FUD is warranted, but in comparison, I would say Circle has kind of steered clear mostly of any of that. and it's trusted, and it's also kind of redeemable for real dollars in a lot of the venues that matter for a lot of the market participants. Especially in the US, where most users have a Coinbase account and they can seamlessly transfer their USDC or convert their USDC into USD. Yeah,
convertibility.
That ties in right into the mission for Circle, right? Promote economic prosperity through the frictionless movement of value across blockchains and the internet. The fact that the fact that we are redeemable for $1 by anyone who's got the account. There's so many anchors, or what we call fiat on and off ramps, all over the globe at this point in time. The title of this is Scaling DeFi, right? And so as far as scalability goes, having this regulated entity that is the most trusted stablecoin out there, pegged to the dollar, backed by hard reserves, it gives, kind of going back to some of my earlier points about some of the traditional asset managers moving into the space, it gives you a base layer. It gives you a kind of floor to what you are using in making your investments in this space.
Folks, we have had some great questions thus far. We shall be covering a few more topics in the Twitter Spaces that occurs afterwards. It'll take place at 8:15 ET. We'll be having a little tea break, as we have here in the UK, or a coffee break over in the States, or otherwise in the rest of the world. But just before we wrap up, I thought it'd be good, just as a final closing moment for this webinar, when we're thinking of scaling DeFi, it is, of course, the main thrust of this webinar. How do you think DeFi will scale? If you just had to condense it down over the next year, what is the manner in which you expect DeFi will scale over that period of time? Sorry that I am putting you all on the spot here a little bit, but Yutaro, I'll start off with you. How do you think DeFi will scale over the next year?
I don't usually use this term, but I'll just borrow a term that's used in Solana, which is eating glass, I suppose. There's no shortcut solution to this. The Solana, the excellent Solana team is going to have to and will continuously improve the blockchain. The application developers will have to continue to iterate and experiment to see what works. And the general ecosystem participants will have to try these out and as market participants determine which solutions work best. I think at this point there will be a few 0 to 1 type innovations, but I think a lot of it, at least from my perspective, will be fairly iterative.
Very good. Ben, how would you think DeFi will scale, especially within Solana over the next year?
Yeah, I kind of echo Yutaro's, but also, generally, crypto is just going to proliferate more and more people are going to try out crypto applications, and more people are going to get exposed to the Solana ecosystem. So it's on us at Solana Foundation, Solana Labs, to ensure that we are capturing some of those users when they are coming over. And that's why we're doing a lot of these in-person events, such as the Solana Miami Hackathon, which is happening currently, and will be going on for the rest of the week. So if anyone's in town, please stop by. The RSVP is on. It's completely free to attend. So it will scale on the basis of more people coming into crypto and being exposed to these applications and the benefits of these applications. But I think to drill down more specifically on DeFi, it unfortunately doesn't reach a scale that many people care about unless you play by the rules in some capacity. So I do think that regulation is going to be very important to getting that step function change in DeFi from just a few niche million users around the world using it to billions of users all over the world. So I think that is going to be a primary focus for us, working very closely with the regulators to make intelligent ways that we can regulate DeFi without neutering the benefits of it.
Yep. Can I jump right in there if I may?
Go for it.
Because to me, I feel like DeFi first started out as investors chasing abnormal yields for very short periods of time. That's all fun and dandy, but to really grow and to really scale DeFi into what it truly could be, decentralized finance around the globe, what Ben was saying was correct. We need to have regulation. There will be some growing pains in this as well, but there is going to have to be a movement away from again, the initial kind of use cases, which was these abnormal yields, into trading applications like Orca and into other types of applications I mentioned trade finance a couple times because I see that happening a lot lately. But that's going to be the key. We're going to move away from chasing abnormally high yield for a short period of time into building decentralized protocols into the processes of traditional financial movements around the globe.
Juan, any expansion on that? How do you think DeFi is going to scale over the next year?
Yeah, no, I mean, over the next year it's I think relatively short compared to how long we have and how early we are. But if I were to put it on one thing, I think it would be user experience design. So whether it's deploying liquidity, signing a transaction, creating a wallet, securing your seed phrase, I think it's innovation at the user experience design and front-end design of applications that will scale DeFi and make it just really easy and seamless for users to participate. So I'm not worried about the blockchain layer or the technical component of maybe how block space scales over time. But I think it's once we make it really easy and seamless for folks to use this technology that it'll scale.
Very good. I think we shall start to close up here, but just before we go, thank you to all of our panelists. This has been a great chat. Hope several of you, as many of you as you can join us in the Twitter spaces. Just before we head off, I thought it'd be good for any of our viewers who want to learn more about what each of you do with your respective projects, what you're all up to, where to find out more about what it is that you do. So Ben, just starting off with you, where can our viewers find out more about what you're up to with Solana?
I'm tweeting all day long. You can find me on Twitter at Benny Bitcoins, Bitcoins with an S.
Perfect. Steve?
Yeah, primarily would certainly be going to circle.com's website for anything and everything about USDC. On a personal basis, I'm on Twitter at SG, my last name Leahy. That's me.
Perfect. And Juan?
I don't tweet as much as I would like to, but I'm on Twitter at Laguna Sounds. It's mostly about my music. But yeah, anything Circle USDC related would be at CirclePay on Twitter, which will be on at 8:15.
And Yutaro, is it raw falafel?
It's raw falafel, like falafel, the thing that you eat that's filled with chickpeas. But you can also Google me, my real name, and you should be able to find me.
Perfect. Well, there you have it, folks. That was Scaling DeFi, a dive into the future of decentralized finance. I hope you enjoyed that. There will be a recording of this made available too. And I hope some of you will be able to join us in the Twitter spaces that will be taking place in just a quarter of an hour from now. That will be on the Circle Twitter. So it's at CirclePay if you want to join us there. That's all from our great panel for the minute. And we'll hopefully see you in the Twitter spaces. That's all from us for the moment. We'll see you in the next one. Bye-bye.
Thank you, boss.